Hello everyone, today is February 25th and this is our session number 8 of the Wyckoff trading course. Thank you for sending your homeworks, your notes, your questions. We're going to go through this today. Next session is going to be on March 4th. At the same time, a few comments here really quick. We have a lot of things to cover today, so this is going to be really fast. I kind of highlighted the thoughts that I wanted to talk about. From your comments, you could read the full comment after after the class when you watch the video. So here is a comment. I'm moving from a state of feeling I'm understanding this moments of total confusion. I'm sorry. I'm moving from a state of a feeling I'm understanding this to moments of total confusion. So, and then another comment here. I interpret this as a good sign of absorption, so which I really like. You said to grind it out, and this is and this course is so interesting. Okay, yeah. So definitely from a teaching learning perspective, this is a great comment, and I'm really pleased to hear that. Why? Well, because the course is constructed in such a way that I'm giving you layers of information. So for instance, we started with the price structural analysis, and there were so many layers, sub-layers under that subject. Now we switched to the volume and price analysis. And the first session was the hardest session for you guys. A lot of you were telling me how it was difficult, to understand those concepts, and they were, kind of like not very intuitive concepts. So therefore, you are absolutely going to get into the point of confusion again in the course. Why? Well, because that knowledge is not there, or it's not maybe a correct knowledge, maybe it's not cemented correctly. So we kind of build the foundation again, and to build that foundation, you got to get uncomfortable first with something that you don't know. And then just trust the process, trust me as a teacher to get you to the place of understanding. And this is what I'm receiving today from all of you or throughout the week, is that the message in the emails like, I'm getting it. Yeah, I am getting more comfortable. I understand the concept. So that's great. That's exactly the process that we want to go through all of the concepts that we have, all of the concepts that we go through. Next comment. And here, I just want, again, kind of like to go to the same statement of grind it out. Just it's the stuff that you have to learn. If you really want to use this in a very practical way, either understanding the market, analyzing the markets, or trading the markets, then you have to study. And you have to, study consistently. I was just today watching the video with Arnold Schwarzenegger, and he was talking about, I don't know what it was, but he was talking about how he was practicing for the Mr. Universe, and then the movie career, and the politics, and so on and so forth. And he's just every day. I was in the gym for 5 hours. People were asking me why, and he said I have a goal. So we have a goal here. We have a goal to understand this material to the point where we can practically apply it to the markets and extract the money from the markets. That's our goal. So let's keep grinding to the point where we go from a state of feeling of understanding to the confusion, and then to understanding again. And that would definitely make me so happy. This past lesson has really helped to solidify things in my mind, even though there is so much more to learn for certain. Now, after only 7 lessons, I can visualize the markets in a whole different light. And this is very important as well. So this is the time when, students come to me and they say like, whoa, now I see it differently. Now I see the structures everywhere. I see the change of environments. I see how different phases unfold. I mean, obviously I have to learn more, and I have to develop the skill, but that's the initial feeling. It's like a feeling of excitement that you see the market in a different light now, and it makes more sense. Why? Well, because it's more systematic. It's more kind of like something that where you translate the data that comes into your mind through the visualization, through the chart, and then you're saying that I know this pattern. It seems like this is the behavior of composite operator or something else. So if you're there, if all of these changes that different students are reporting to me via emails are happening to you, you are in the correct phase of your studies and you're developing correctly. If you feel that you're not there, if you feel like still the price structural analysis causes some hesitation, some kind of like level of uncomfort, and specifically with the volume and spread analysis, you're still uncomfortable, shoot me an email and say like, what can I do? And my answer is probably going to be kind of the same. There are multiple options here. And if you want to continue with the studies and understand this material really well, then my first suggestion would be continue with the course right now, finish the course, and then next cycle, which will be a summer cycle, enroll as an alumni. The alumni rate for the next cycle is going to be $398, something like $400. I'm doing this with the purpose that some of you are going to come back. There are quite a few alumni in this class. And it's always beneficial to repeat this material. So if you feel like you're a little bit behind, no worries. You could repeat the course again. You could just watch the videos again. That would be the easiest, cheapest way to do this. But in general, I'm pretty satisfied where the group is. So we're just gonna build on what we're building, have built in the 7 sessions. And specifically, volume and spread analysis still needs a lot of work. Still needs a lot of repetition for us to feel comfortable about that. So for the next, 2-3 sessions, we'll definitely do that. Today, we will go first through volume phase analysis. This is where we are identifying volume in the specific phases of the consolidation. And today specifically, we will be talking about supply signatures, whether we identify those in accumulation or distribution. Next session, session number 9, we'll talk about the volume phase analysis again, and we'll talk about the demand signatures. We're going to go into some Q&A. There were a couple of very interesting comments and questions. I want to go to those. And then we're going to come back to our group exercise on the supply and demand. And as usual, I look forward to hearing from volunteers. We're going to do, again, volunteers going through the exercise and me giving you guys a live feedback. So be prepared whenever I'm going to ask you. Just say yes, and I'll unmute you and we'll do this. Group exercise is this, homework is a group exercise again. And this is where, again, I want to receive your notes after watching the recording again. We'll talk about this at the end of the session again. It's so crucial to do that, especially if you're extremely serious about this stuff. Again, I totally feel okay with students who are more advanced students, and I feel from them kind of like a determination to get this material and to assimilate this material to the highest level of understanding. And this type of students I'm going to be most strict with, and I'm going to push you guys so that you would produce even more during this limited time with me. Having said this, for somebody who's just attending classes and just observing the classes and listening and kind of incorporating it at just the level of listening, that's fine too. I totally understand where you are, and I think the most important thing for a student like yourself is just to listen, just to be present. But be present for this 2.5-3 hours with full capacity. So if this is the only time when you can listen to this recording or when you can attend a live class, do me a favor and yourself a favor. Be fully engaged and be fully kind of like present, and that will go a long way. All right, next session, we also going to go into some volume case studies. Those are one of my favorite case studies, just in general, because volume is just so fascinating to me. You know, how we look at the volume, how we interpret the volume, especially in the relationship to the price. So we're going to look at some of the case studies. Okay, let's go to the material, and we're going to start with the volume phase analysis, and specifically we'll discuss the supply signatures in accumulation and the distribution. The question that I want you to keep addressing in your mind is, what are the main supply signatures in accumulation and distribution formations? How do they differ? Right? So supply could increase both in accumulation and in the distribution. Supply could decrease in both accumulation and in distribution. So what are the differences there, and what are the price structures would look like if supply signature occurs under different bias definition? All right, let's look at the first one. So this is a schematic that I built for you guys a long time ago. The most common question here, unfortunately, is not related to the volume signature. The most common question here is, why is it not a horizontal range? Well, guys, I don't know. I was just drawing. I was not thinking. It just kind of came out of the inspiration, and this is what I drew. And when I drew it, I realized it's just a downsloping range. So there is no intention here to show, let's say an increase of the supply signature and then relate this to the specific structure. It's just what it is, just a schematic. It's a theoretical representation of the supply signature in the accumulation throughout different phases. And we'll talk about the two main examples of the accumulation reaccumulation supply signature. That is example number 1 and example number 2. These two examples have very specific characteristic between phases of supply signature between phases A and C. As you could see, going from phase A to phase C, we do have a decrease in supply signature. And that's a very important thing for us to see. Because everywhere else, we're going to see either increase into phase B or increase of the supply into phase C. So the more common supply signatures in accumulation reaccumulations, the ones that we really look forward to see and identify, are going to be where supply in general, and we're going to say that this is a long-term supply signature, supply would go down from phase A to phase C. Now there could be some variations on the volume signature in phase B. Sometimes it's going to dry out a lot, and then it's going to locally increase from phase B into the phase C test. And then we're going to say that from phase A to C, which is kind of like a long-term supply signature for us in the consolidation, supply went down, and this is a bullish sign. And then from phase B to phase C, which is a short-term supply for us, more of the local formation supply, we're going to say that supply could potentially increase, but that also is going to draw an increase in the demand signature, because increase of the supply signature is going to be identified by the selling of weak hands, selling by weak hands, I'm sorry, and then demand, increase of the demand is going to be identified by strong hands buying. Weak hands are selling because of fear. It's a second point of fear. strong hands are buying because there is liquidity in phase C and value. All right. And then a variation where phase B still would have a considerable supply relative to phase A. So phase B here, the characteristic of the supply is going to be still considerable. And that requires some kind of testing, and therefore diminishing supply signature into phase C. So these are the two most common supply signatures that we want to see in the accumulation, reaccumulation. Now let's look at some of the supply signatures that are going to be somewhat difficult for us to interpret. And we would really have to rely a lot on the price action in the work like this. So supply signature number 3 has a very interesting increase of the supply into phase B. And usually that type of increase of the supply into phase B is going to be associated with some kind of, shakeout type of action, shakeout type of reaction. Let's think about the sentiment here. Why is it that there is a lot of selling? Well, think about what has happened before. A downtrend, a stop in action. So supply was increasing a lot at this spot. So the sentiment is still very much bearish. And then if that sentiment still persists, then on the next reversal after the automatic rally or after some kind of upthrust, we are going to see that the bears are going to come back and they're going to still be dominant on the sentiment side. And that's going to produce a wave of selling that could take us to a lower low. Now, in this case, the downslope actually works really well with this definition. So we would see that increase in phase C of supply. We could see that the price might go below the level of the support, and the supply is going to be higher than supply in phase A, the stop in supply. And then going into phase C, what we want to see two things. The first one is that the supply decrease from B to phase C. And then the second thing that we want to see is supply decrease from phase A to phase C. So why are those two important? Phase B supply is the highest. It almost sometimes could be identified as the stop in supply. And in some cases, I see labeling mistakes where phase B lower low looks like selling climax, but the change of character has already come prior to that. So the change of character would define phase A, would define the stop in action, would define the automatic rally, and then phase B would just have, a sign of weakness. Sometimes it happens, just because the sentiment has not changed, and there are still quite a lot of sellers in the market. And then, obviously, we could also argue that the quality of the demand itself might not be sufficient enough in order for us to, create the low that is going to be on the same level as the selling climax, or more favorable higher low. So we want to see how supply in phase C is going to diminish relative to what we've seen in phase B. So it has to be a somewhat of considerable decrease of the supply. And we also want to identify the decrease of the supply from phase A to phase C, because at the beginning of this trading range, of this formation, phase A supply was a stop in supply, in a way that it increased the liquidity, which brought in the demand increase, and the overall volume signature has increased, and that produced the stop in action. So I'm just saying stop in supply from that point of view. But then going into phase C, we want to see that supply is so exhausted, and it has been observed in phases A and phase B that supply in phase C is just negligent. No one else is selling at this point. And that would be the timing for us to identify the beginning of the move for this particular stock. Okay, supply signature scenario number 4. This one is even more tricky because we have a very substantial supply of increase of the supply going into phase C. So let's just think why this would happen. Why would we have a period of accumulation, and then at the end of the accumulation we're going to have almost like a climactic type of supply? Well, there are quite a few things that could happen in such a way that the structure, the price structure, will be constructed as an accumulation, and that supply signature will be the highest in phase C. Imagine a situation where a composite operator, strong hands, were accumulating the stock for quite some time. And then the news, let's say some earnings, or maybe some management change, or maybe unfavorable government, ruling against the company has happened. What that is going to produce is a quick general liquidation out of this position by weak hands. And while this is happening, CO accumulates with the purpose to have a sustainable business cycle move in the stock. So therefore, they see this increased liquidity and opportunity and the point of fear from weak hands as an opportunity to load up even more, to create a very sizable position, to control more supply. So therefore, they are absorbing a lot of the supply that's coming in, and the not only supply signature, demand signature is increasing very rapidly, and the volume signature increases rapidly just because of both supply and demand is increasing. In other words, only the CEO is believing that the company is going to overcome, a bad news in the moment, and the CEO is observing whatever supply from weak hands is coming at a very rapid pace. So that's what could happen here. So on the price structure, we usually would see this type of moves as sprints, and rather deep sprints, or just a shakeout. Please note that if this supply signature is going to come on a sign of weakness, it's going to look the same. Because if we're talking about the shakeout and the major sign of weakness, in a lot of cases they might look the same. And it's only what comes afterwards is going to define in reality what it's going to be. So keep this in mind, that we always have to come back to the price structural analysis. We always have to see, with the increase in supply signature, what does the price do? All right. Great. Let's go to the next slide. Well, let's look at some of the examples. So here is our first scenario where we see that there is a long-term deterioration of the supply from phase A to phase C. And then locally, we could see that phase B has kind of like a smaller supply, and then locally supply is increasing going into phase C. So let's look at the example. This is Amgen weekly chart. We have had an uptrend, so therefore this is a buying climax, automatic rally, or a shakeout, however you would label this. I would probably label this as a shakeout. Why? Well, look at this bar right here. with the big volume signature, that suggests some kind of in the reaccumulation, more of the rotational shakeout type of action, where some of the institutions are taking profits, so they are get rid of their position or scaling out, and then other institutions seeing still a lot of value. And that usually happens in a lot of leadership stocks. Look at the Boeing just recently. Look at Cisco just recently. And by recently, I mean 2018, the trading ranges that they have had. They have the same type of structure of upsloping reaccumulation range that starts with the rotational distribution that has elements of the shakeout action right here on the increased volume signature, increased spread, but an ability to produce a significant result and commitment to the downside below the support. So that's what starts the trading range. It's that shakeout rotational distribution type of action. So then the next rally is going to be automatic rally, and look at the characteristics of the automatic rally here. A lot of volume coming in, a lot of demand coming in, and then it produces a really good quick jump back to the area of the resistance. Those are the characteristics of the automatic rally in the reaccumulation. That just tells us that whatever supply has come in, quickly it's being absorbed in phase A. And then the next test is just going to be a test of what has happened on the changes of character twice, on the way down and on the way up. So and that final test shows us that yes, supply is under control, and whatever supply is coming in, specifically on this bar right here, after that it's even lower, lower, low throughout this local structure. All right, so then as we go through phase B, look at how supply is diminishing and just staying very, very low. And it's only going into phase C that we are starting to have, some volume spikes that are not necessarily were not present in phase B. They were, but we are looking also at kind of like the overall picture, overall volume signature, right, or averaging. We're seeing here, I don't know if you guys could see this. This is the moving average right here on volume. And we see how the volume signature diminishes, diminishes, diminishes. And then we have that volume spike that has a little bit of the consistency of the increased supply. So we are seeing that locally from phase A to phase B, a very clear, definitive decrease of the supply. Look at the price, what the price is doing with that decrease of the supply. Is there an ease of movement to the downside where the price starts committing below specific levels of the support? No, right? So every time we come to the level of the support, we are springing back. We're springing back, springing back, springing back. Not even springing back, but going up without touching the support. And we are not even touching the lower support in this area right here. And all of those spring type actions in phase B, they happen much, much higher. So that is an element of strength. That would act as a confirmation of what we've experienced in phase A. And you kind of could see at this point how analysis becomes more of the rolling over analysis, right? So I've used this semantic before, and I really like this. Rolling over analysis, meaning that in phase A, we are determining the bias, and then we are rolling over into phase B, and we are confirming that bias in phase B, and then we are rolling over into phase C, and we're confirming it in phase C. So that way, you have more handle on the logic as it unfolds. All right, so locally we could see that phase B supply is very low, then slight increase into phase C, and I like how supply slightly increases into phase C. It doesn't have to be a big volume signature, but even with this small increase of the supply, it tells us the story that whatever sell-in we have by weekends, it's not very strong. And because it's not very strong, then whatever supply comes in could be easily absorbed by institutions at the levels probably of a higher support level rather than lower support level. And we kind of see that a spring situation happens and relates to this support level in phase B, not for the support at the support level in phase A. So, and that's a very big distinction. We'll talk about this more in the Wyckoff practicum. Those are more advanced concepts. And then obviously we want to compare the emergence of the supply in phase C to phase A, and we're seeing obviously a long-term deterioration of the supply. So all of those elements are confirming our reaccumulation bias. Then by itself, increase in the volume signature suggests that we could be possibly in phase C. So all of those definitions for phase C that we went through, we said that we need to have 3 tests. Then we need to have a second point of fear. And look how second point of fear is going to be related to that local increase of the supply from B to C. So that's that second point of fear. But second point of fear, in a lot of cases, are just going to be obviously not as fearful as our phase A. And then you could identify phase C also by the volume signature. And specifically in this type of structure, we're looking for the volume increase, or we're looking for the supply increase and demand increase at the same time. So that's our volume equation right there. Okay, comments, questions, let me see. Any particular time period for the moving average? So I don't know what the moving average right here. I would just go with some basic definitions like 21, 22, 20. This would define the monthly moving average, so something like this. On the weekly chart though, you probably would want maybe like 2 quarters. So that would be like 40 weeks, I believe. Actually, not 2 quarters. What am I saying? Yes. 63 days. So that would be, yeah, to about 63 days. But I'm not necessarily using that type of indicator. I already don't remember, how it got in here. I think this is from TradeStation. So you could see and visualize the volume in different ways. You don't have to have the volume average. I am seeing that in this area right here, the volume is completely different than, let's say, somewhere here. And then it just has some kind of characteristics of the increased volume signature. So to me, the volume signature still looks the same, right? So we're going lower into B, slightly increasing into C. And still there is a diminution. Supply signature and volume signature into C from A. Okay, great. Let's look at the next example. And this one is where the volume signature in phase A is going to be the highest. And usually this is going to be a CO, seeking that opportunity to accumulate the stocks at the point of fear. So accumulate majority of holdings in phase A. So we are seeing from the volume signature that the stop in action is going to be where supply is going to be the highest and is going to reflect the supply that is of weak hands and supply that is a panic supply where we are clearly experiencing a first point of fear. This is where big institutions are seeing value. We were discussing the other day Goldman Sachs trade that Warren Buffett was conducting in 2008. He was buying on the way down because that presented an immense liquidity and value opportunity for him for the stock that he considered to be a leadership stock and the value at $120 and below. for that particular stock. And then going into phase B, we're still going to have a considerable supply. And again, you know, the story here is all about the sentiment. I mean, think about the sentiment at this spot right here. You just came down really sharply, you stopped for a second, you had a rally, and then after that, all other subsequent rallies are failing. There is one failed rally, there is the second failed rally relative to this high of the automatic rally. So what do you think the sentiment is at this point? Well, obviously, there were a lot of sellers on the way down into the climactic action, but some of them have not sold. You know, and some of them still are keeping positions. So as the price starts to reverse and it starts to go down, they will be saying, well, I don't want really to lose this opportunity again to sell at a slightly higher level, and I don't want the price to tank. They're going to be feeling extremely good at around the new lows. And then as the price would come back into the trading range, then they're going to start experiencing some emotional pain. Why did I get out of this position? Look how it came back. You know, maybe if the price will go from this level up, and then as the price finally goes down, they kind of lose the whole interest in this stock and they go away. And that's why, because they go away, they lose their the focus to catch the reversal. That's number one, and then to get into the early stages of the uptrend. And once they miss that early stages of the uptrend, they have to function in the trend that, you know, is already in existence. And this process repeats over and over and over again, and we're just trying to find this on the chart. So still significant, quite significant supply in phase B, suggesting that we have to have some kind of retest around the area of the support both in phases A and B. So we have this support cluster. After the price rallies, it has to come back and retest. So on the failure right here in phase B, there are quite a few trades that you could have, and they still will be in line with the kind of like non-spoken bias, lower highs, lower lows, still definition of a downtrend, conventional technical analysis. So a lot of people are going to see this as a downtrend and not necessarily as a structure. Well, we definitely would see this as a structure. Why? Well, because the structure is defined by the change of the environment that comes from a change of character. At this point, we would be expecting more of the horizontal structure, but because we have lower highs and lower lows, we will be curious to see, after the change of character, how to build a downslope in trading range. And for that, we would take this 4 points, 5 points, connect them together, and look how nicely it projects an attempt to spring here, and then also defines for us the level of the resistance which has to be overcome by the sign of strength rally. And because we are thinking about the downslope information, we are looking at the volume signature and observing the volume signature so that we would understand what's happening with the supply signature going into potential phase C. As we're observing at potential phase C, the question is here, is there sufficient absorption of the supply that has happened throughout all 3 phases, and specifically going into phase C, that at this point, if the price will start going up, the new upswing and the new uptrend will be sustainable. And looking at the volume signature, we definitely see diminishing supply signature, overall diminishing volume signature. Diminishing supply is telling us that there are fewer sellers. So that's bullish. overall diminishing volume signature into phase C suggests to us also that not only there are fewer sellers, but that CO is somewhat less active. Why CO is less active? Well, because CO is close to full position or to full position risk that it's exposed to at this point of time. So therefore, whatever volume signature we're seeing here, that bind by the CO at this spot is less aggressive than, let's say, in phase A. And by itself, it suggests a bullish bias. Because we're thinking, okay, why would they be so active in phases A and B and then inactive in phase A? Well, they've accumulated enough. So if the price confirms by going up and coming back into the trading range, and specifically, with the leaving of the trading range, that would be a major confirmation for us that this is an uptrend developing. But as the price goes up, it confirms this theory about what CO is doing and what the sellers are doing, and we could be thinking that we should get into the position. This is the market, the spiders. This is one of the charts that you guys should definitely study a lot. And this area right here, in different methodologies, it's defined differently. For instance, in IBD, and please correct me if I'm wrong, I don't want to be wrong, follow-through date. And in other methodologies, or specifically in Wyckoff, we would be talking about momentum days. So those momentum days define buying for us, and define buying when the result to the upside is actually increasing for the first time in such a way that suggests to us that supply is down. Please note that momentum is present here as well, and demand is increasing. But this is a slightly different picture. It's almost like a smaller diminishing demand, right? Slightly diminishing demand produces kind of, if not the same, but then close to the same type of run, if we especially take a couple more bars right there. So maybe like the same distance has been covered, but it's done on smaller demand. So it tells us that supply is so exhausted at this point that an ease of movement is happening on diminishing demand, and when the price is kind of like travels the same way. And that gives us the timing for the price finally leaving the trading range. Again, this is very quick on this specific structure, and how supply and demand are interacting with each other, how momentum could confirm that supply has been exhausted. But this is something for practical for us to discuss. Again, and a little bit slightly more advanced concept when we involve momentum into the, let's say, demand signature or the price signature. Let's go to the next example. So this is scenario number 3. So under this scenario here, we are observing supply increase in phase B. So supply in phase B will be the highest supply, and sometimes it will look like a stop in action by itself. And students usually would put a selling climax into this lower low. And their argument is very appealing because the volume signature is climactic, and the spread is also going to be climactic, and that is the lower low at that point of time. Now, what is being overlooked a little bit in this case is the automatic rally that defines a change of character for the drop to the downside, for the reaction that we have. And that reaction also has the largest volume signature at the time. So with the highest volume signature and the change of character, we're thinking that this is a trading range. In this case, again, a downsloping trading range. How would we confirm that this would be indeed the a downsloping structure? Well, take phase C and look into the major sign of strength and see if the backing up action comes exactly to the level of the support that acted before as the resistance. And if it does, then that's your trading range. And if it does, if this is your trading range, then this is probably a selling climax after with the change of character, a secondary test here. And then this is just phase B. So now that we know the structure here in phase B, we are puzzled with the high supply signature. And then again, see how it all unfolds, the structure. There is a lot of selling, so weak hands are capitulating here, or ITFs, institutional trend followers, are capitulating here. And then as the price goes up, it doesn't really show a lot of strength on that move up. So we still could be thinking that there's going to be a continuation to the downside, so the sentiment is pretty bearish at this point. And it's only here on this test. That's the first time when we could say that, it's stopping. So at least for now, we're going to be in some kind of consolidation. All right, so then let's look at the supply in phase C. So what are we seeing here? This is the supply in phase C. And we're seeing that definitely it's somewhat smaller than supply in phase A, and definitely it's decreasing from phase B to phase C. So we have both of those requirements for phase C supply after such a strong increase of the supply in phase B, where supply diminishes both relative to both phases A and B. And then if we miss that, then we want another test, right? So here's another test, but it comes as a structural high or low, but the volume signature increases. And today I'm going to show you a couple of slides from somebody in this class that discusses this exact concept. So look at the volume increase, meaning that supply has increased, and it's a high or low. So usually we talk about a testing action as an element of two things: the price structure, which should be in this case a high or low, and let's just put it here, a successful test. And then we need to see on the volume side diminishing supply signature. In this case, we see that supply is increasing and the structure is still high or low. So we don't have both characteristics that we need. But then look at the next reaction into the backing up action. This is where supply diminishes, and maybe even the average supply is even lower somewhere here. And it happens on the high or low. So this is the first time when we have both conditions here for the successful testing, and that suggests that from now on the price is going to move much freer to the upside. All right, let's see some comments here. Okay, yeah, this I'll have to address. This comes from Lim, and the question is: notice this is an S&P 500 index ETF instead of the index itself. For analyzing the market, is it better to use respective ETF? The volume pattern might be different between the two. Yes, the volume could be different between, let's say, a cash market ETF and, let's say, futures. Yet, my argument to that always is that the volume structure, meaning the way how we see those ups and downs and how the volume is in generally behaves is going to be the same. And if you are going to have some big days like this one right here, most likely it's also a big day in the futures, in the cash market, and so on and so forth. So I definitely get the idea that the volume signature could be so different for the same underlying but different instrument, right? So different capacity, different way of representing that underlying. But at the same time, the volume signature, those patterns are going to look somewhat the same. And that's what I want you to concentrate on. And thank you for asking this question, because every cycle it comes up. Okay, Nilesh is saying phase C tested, and it's kind of hard to see here. It's just like almost on the same level. Phase C test happened on a higher supply, but still made a higher low, which looks bullish. So are we talking about this spot right here? Yeah, this is just an area of increased effort, in this case to the downside, and then diminishing result to the downside, which looks bullish. In this case right here, we're seeing diminishing effort to the downside and diminishing result. So there is a synchronicity between effort and the result, and therefore it's also bullish. So bullish in both cases, but different interpretation. And we're coming to the conclusion that it's bullish bias based on different effort signatures. All right, let's go to the next one. This is that scenario number 4, that sometimes could produce difficulty for us, because when we look at something like this, and this is Amazon daily chart, where there is a huge spread to the downside, and we instantly, on increased climactic volume signature, we instantly are thinking that this is a sign of weakness. And we're looking for the commitment to the downside. And in a lot of cases, we're going to look at this range as a horizontal range, and we might be saying, okay, well, I see that the price is below that support level. So therefore, a sign of weakness is going to be a valid concern. Now, there is a big difference between a sign of weakness and a spring or a shakeout. In this case, even if we're using horizontal range right here, we only have 2 closes below that go below support, and then the price recovers. So this looks more on the horizontal range even as a spring rather than a shakeout. And it happens on a lot of the supply that's coming in, that is capitulation supply, probably just bad news earnings on that particular day. And we're seeing a lot of absorption of this supply as the price starts to show short-term liquidity and value for institutions. Please note where they did this. Again, in phase A, on that rotational leadership distribution, and then in phase C, where a second point of fear, just news, produce some kind of quick bearish sentiment, and weak hands want to get out. And this presents an opportunity for strong hands to get in, absorb the supply, and then hold on to this supply. So from that perspective, it's always going to be difficult to see this type of volume signature, where there is an increase from phase A to phase C, where there is a substantial increase from phase B to phase C, because that would be always attributed to the increased supply and therefore more of the distributional characteristics. And those are going to be wrong. Why? look at the price. What does the price do? And the price is coming back really quickly into the trading range. And whether you're using downsloping trading range or just horizontal, already somewhere here in phase D, you might be thinking there is something wrong with this sign of weakness. It should have committed below, and the rally after this should have been weak, and then we should have had a continuation. Instead, the price came back lively into the trading range, and then it stays up in the reactionary mode, and it doesn't go down. So our bias should change at that point, if not before. All right. Okay, let's talk about the supply signatures now in Wyckoff phases of the distribution. And again, there was no really a lot of thinking about the trading ranges that I wanted to identify here. But then after actually drawing for the distribution, it does make sense. It does make sense to discuss specific scenarios. So it's not like we're discussing a specific scenario of the upsloping distribution. It could have been a horizontal distribution as well. But in the second case, the interpretation of the structure with the volume signature is going to be crucial. So let's think about just very common beliefs from our methodology as to how the supply should be behaving in the distribution and redistribution structure. So in general, the two most common volume signatures that we should see is an increase of the supply throughout the whole structure, and not just into phase C, but into phase D. Because phase D is going to be the first phase where we're going to see that increase of the pressure to the downside as effort increases, and at the same time result will follow that pressure, and it will produce a much better result than anything else. Those are the characteristics of the change of character, and that change of character suggests that we were in the distribution formation, and now is timing for the downtrend to unfold. And that increase of the supply is going to be throughout the whole structure. So in general, for accumulation, we would be talking about absorption of the supply, so therefore diminishing supply signature. And then for the distribution, we will be talking about the increase of volatility, increase of the volume signature, increase of the supply signature, and that should start producing some kind of result to the downside with the emergence of the downtrend on the lower highs and lower lows. So that's the most common signature. Signature number 2 is just going to have a variation on phase B supply, we might go into more details, nuances in the practicum course, where we'll be talking about that phase B volume signature in the distribution. Sometimes signature with lesser supply would suggest that we are going to have some kind of more of the upthrust action into phase C. And then a higher supply signature might actually suggest that we are going to have more of the LPSY in phase C. And it's all relates to the levels of the supply that we should be observing in phase B, and how phase C and phase D could unfold. Then let's go to a more specific distributional formation, which we will call a TP formation. Please don't forget that TP family would also have a hypodermic structure, could have hypodermic. And basically the volume signature here in hypodermic is going to be the same, with the exception that there's going to be a collapse between phases A and D, and everything is going to happen so fast. So you could see a lot of volume signature increase even throughout, all of the phases, rather than just in A or D. But for the TP formation, one of the things that we need to remember is that there is an excitement on the way up in the upswing. So weak hands are buying, and then strong hands, the CO, is selling into strength. And then there is something on the horizon for this company, or maybe for the market in general, or maybe for the group, that CO does not like. And the CO wants to get rid of this position as soon as possible. The CO does not want to wait. It's going to sell on the way up, and it's also going to sell on the way down. And this distribution on the way down is going to happen really fast. So therefore, we're given a definition of urgency to this action. There is an urgent distribution by the CO. There is an urgent distribution by institutions at this point. Now, this urgency to distribute lowers the supply of their stock significantly. So they are, CO is either out completely, or it has a very low level of supply of shares that is left. So what does it mean? It means that going into phase B and C and even potential D, but let's just keep it at B and C, the CO is going to be inactive. And if CO is inactive, then overall volume signature should go down, supply should go down, demand should go down. And usually this type of situations where volume goes down and both supply and demand goes down are going to produce some kind of apex formations, triangles. And usually apex and triangles are going to be always associated with indecision. If you think about this, guys, why indecision at this spot? Who's indecision? Who doesn't know what to do? Well, the CO is out, so there is no decision there. So in a way, that's kind of cool that there is no decision by the CO. The CO has made the decision, and now it's inactive. So indecision, more by who? Well, I would say more by ITFs, institutional trend followers. Why indecision here? Well, because they are still technically in an uptrend definition. Because this trend for them is going to have a higher low, a higher high, and then it's going to have a consolidation, a trading range. So the trend is not broken yet. But then once they go through more than, let's say, 2 quarters of, let's say, absolute and relative underperformance. So think about the market in this period of time might be going up. So absolute return on the stock is not going to be there. And the relative performance also could be in jeopardy. So therefore, what would institutional trend followers do? They're going to start scaling out of this position. And that's what's going to finally increase the size. So ITFs are selling. And ironically, this selling, that's what's going to produce after the lower high, the next lower low. So, and then the structure behind becomes more with the more visually detectable bias to the downside. Everything is so connected. It's like a living organism. You know, there is a sell-in, there is still some hope, failure of that hope, and then there is a final capitulation. That's how the sentiment unfolds through the structure. Okay, let's look at scenario number 4. And it's just basically the same. We could apply the same structure, right? We're still going to have some urgency to sell, and relative to phase B and phase C, the supply is going to be quite significant in phase A. But then more supply in phase E. So what it would tell us is that the sell-in here on the way down out of the apex, sell-in is much more than in phase A. And therefore, we know that some of the institutions sold in phase A, but it doesn't mean that all of the institutions sold in phase A. So they're going to start selling again in phase D, and that's what's going to produce a more meaningful volume signature. And usually with this type of volume signature, that movement is going to be much faster. Because think about, you know, increase of the supply as kind of like an urgent supply coming in on the capitulation after the apex rather than off the top. So in this type of environment, you're going to have a lot of gaps down, and that's going to happen on kind of like this extremely climactic volume signature. Okay. All right, great. Question from Philip. Why are we using phases D and E instead of C as an accumulation? Okay, so this is a good question. So we think about phase C here, right? So usually in the accumulation, we would be thinking about phase C as an element of supply increase because the weak hands are selling here at this point. They're capitulating. Now in distribution, it's going to be the opposite, right? So we're not talking about the demand. We would be demand and rally. Demand rally is going to be equivalent of this and this in accumulation and the distribution. But we are talking about supply signature, not demand signature. So therefore, we want to look at the reactions in the distribution. And this is where phase D is going to have that major sign of weakness as a reaction. So we're discussing that. Okay. Let's look at some examples. So this is a redistributional trading range. JCPenney monthly chart after a big downtrend that had already seen a lot of selling. We have a move out of the deeply oversold condition. And actually, I remember I was, you know, trading consulting some of the institutional clients on this stock. They were extremely excited at this point because the big news at the time in 2011, I believe, was that one of the Apple designers is coming to JCPenney, and he's going to produce the same type of following with the stores that Apple has created by that time. And nothing from that materialized, and then we kind of went back into a downtrend again. But look at how technically we would define that this is a distribution based on the supply signature in this trading range. As we go through different phases, look how gradually supply is increasing throughout the whole structure. And again, we're not using phase C rally for identification of the supply. We are only talking about reactions. in the trading range. So on these reactions, we see how supply is gradually increasing, and then what happens with the result? Look at this reaction, look at this reaction, and then look at this reaction. So this is where result to the downside is increasing on the increased volume signature or on the increased effort to the downside. Bullish or bearish? Definitely bearish. And this defines the timing for us. There is a synchronicity between the increase in effort and the increase in the result. And that's exactly what we look for the change of character and so on and so forth. So this is the most common supply signature. Here's a TP formation, right? So we've talked about this, but I'm using a slightly different schematic here. And I'm doing this just because it looks that maybe, well, actually supply slightly increased here, definitely increased here, definitely increased here. So probably it should be scenario number 3 instead of scenario number 2 here. But the principle is going to be the same. In the TP formation, as we went through the schematic, a big climactic run, speculation on the way up. Then CO is going to say, I need to distribute really fast. Something is coming up for this stock. And we are at such high prices here, speculative prices, where it's overvalued. So they're quickly trying to close out this position, and they're just basically selling on the way down. And that produces those gaps, those quick moves, that sign of weakness in phase B, just because they still keep selling and selling until they are done with selling. And once they are done, the CO is done, look what happens. There is some value here at this spot, at this low, for some people, for some institutions. And that's what produces this biggest rally in Apex at kind of like the foundation of the Apex. It's going to be the widest rally just because of value proposition in the leadership stock after a significant move to the downside that was produced by the urgent distribution by the CO. Please note how if CO is smart money, strong hands, and it's out, still some other institutions, and this is an institutional signature right here on this rally in phase B. Some other institutions, and specifically, trend followers, are going to get into this position because they're thinking this is a high low, the uptrend is still in place. So we are in the oversold condition, which is true, short-term oversold, and there is some value here. What they are not recognizing is this is all short-term, oversold, short-term value, short-term liquidity. And they are getting trapped. And once they are in this position, they bought into this position, look what happens. CO is inactive. And I'm repeating all these concepts just because we do need to repeat all these concepts. ITFs are in, so they are not biased, right? So they're in a position. And therefore they just hold in to the position and doing nothing, so also inactive. And then public, weak hands, is in the position as well on this low right here. So I have quite a few friends that definitely know what I do for a living. They know that I trade. They know that I teach trading. And in a lot of cases, especially in the very good market, like 2017 was the market like that, where everybody would come to me and they would ask me questions as to what do you think about this stock and so on and so forth. So a lot of them in 2018 at the beginning of 2018 were coming into me on this rally. And they were basically saying, we're still in the uptrend. This is a substantial reaction, so that suggests some value. So I bought this stock, and I want to see what you're going to say. So my answer always was more of, let's just wait and see, because we need to go through the period of testing. And in a lot of cases, they would buy stocks like this that would look short-term bullish, but long-term they would fail. And that failure is going to come through all of these people being where they are without a lot of activity. And this inactivity, that's what's going to produce the apex formation. And then only after the period of underperformance, and in this case, this is a quite considerable period. I mean, look at this, 1 year of underperformance. And this is 2005, so we could assume that this could be, both absolute and relative underperformance, if you remember how the market is unfolding. And then after this period of underperformance, the ITFs that were in this position, they're going to give up. So this is them right here, giving up on their positions. So ITFs selling. And then they're going to start selling again. And then with that selling, it's not only going to become institutional, but also going to become more of a general selling, where both weak hands and institutions are selling, leading us to the conclusion like this, where we are thinking about maybe a climactic action. All right, let's go to the next one. Oh, this is a group exercise, so this is great. So look at this supply signature. And by the way, I need one volunteer, so say yes. Look at this, 2 supply signatures for accumulation and the distribution. And I want you to think about, when we're going to look at the next chart, about the commonalities that we might have in the accumulation and the distribution. And the biggest question that we'll have to address with the next exercise is going to be, how do we look at the same supply signature and yet define the bias in a different way? So let's look at these 2 charts. And I need a volunteer. So for a volunteer, please say yes. So it's the same stock. Apollo, it's an educational stock. Weekly time frame, but the period is a little bit different, right? So we are here in 98, 2000. Here we are in 2004, 2006. So definitely different market conditions, but still we're looking at somewhat of the same structure. What are we looking at? We're looking at the previous uptrend. We're looking at the first leg to the downside. Then we're looking at this series of lower highs, and in phase B, not necessarily lower lows, but kind of like this apex formation going into the next move to the downside right here. So it looks kind of the same, and look at the supply signature from phase A volume, where it's really high. We are going into the diminishing supply signature into phase B, diminishing supply signature into phase B, and then we have somewhat of the increase, slight local increase of the supply in the case of the accumulation into phase C, and in the case of the distribution into phase D. So everything looks very similar. So my question to you here is, if everything looks so similar, with the supply and the volume signature, and the structure looks almost the same. I mean, like, look at this structure. This is just uncanny how it develops. Then how do we in this world gonna define accumulation and differentiate from accumulation to the distribution? So let's go to Philip, and let's kind of have this discussion here. Hi, Philip. How you doing?
Hello, great. How are you?
Good. So what do you think would be the difference for us here? How would we be differentiating between this two biases with the same structure and with the same volume signature?
Well, I don't really know. I have no ideas.
Okay. Okay. Well, that's great. Okay. So let's think about it together, right? So, what is different here on these two charts? And like, what is the main major difference that you see?
Maybe the slope of the uptrend beforehand.
Okay, how about now?
Okay. Um,
Okay, so a
Not
question
sure.
for everyone. What is the major difference between these two charts? Guys, don't overthink this. There's nothing really to think about this. Look at how the chart unfolds up to this point, and then give me what you see in a different way of what happens afterwards.
Yeah, the direction of the continuation of the trend.
Yeah, maybe I should just do this exercise in a slightly different way. Maybe I should just show the chart up to this point right here, and then for us to discuss that sprint situation, right? And then to see different result to the upside and to the downside here. So let's come to this point right here, and let's just think what is happening in the potential phase C. Because when we look at the accumulation, we could definitely see that phase C, but it looks the same to me, Philip,
Yep.
on this example as well. So then, where is the point of decision for us to decide that one is an accumulation and then another is a distribution?
Yeah, the direction of the trend after the phase
Which
C.
particular bar?
Okay. The bar. So in the graph on top, the bar right after the 2000, the second bar after the 2000.
Okay, this one. Why?
Yeah.
Why
Well,
this bar?
because
Why not another bar?
because of the gap up and the size of the bar, and when I compare it to the bar at the same position in the graph down, there is a clear difference in them. So maybe that.
Okay, but what's that difference?
The direction of the candle.
Okay,
Bullish.
but okay, so direction of the candle. Well, we have a directional candle up right here as well.
Okay.
Something very fundamental that is being missed right here. Okay, so Philip, thank you. Let me just
Yeah, thank
go
you.
through this myself. I want to make sure that we will see this right away. So think about phase C here, right? If we're thinking about accumulation and we're kind of confirming that this is the pattern that we want to see from the supply signature, this is the structure that we want to see. We want to see going into the spring, a low, and then a test of this low as a higher low, right? And then after that, we want to see a resumption of the uptrend. How would we see this? And I think that's what Philip was trying to communicate. This was a reversal bar out of the test. Now what happens here? The same potential phase C. And after this spring, we are waiting for the test. Now the test again should be a higher low and should be on diminished volume signature. Instead, what do we have? We have a commitment below the spring. So this commitment right here is where spring definition fails, and it becomes a sign of weakness. It's that spring number one that I don't like that much, that definition. Why I don't like this much? Well, because I think it's better to define the bias here. I mean, this is the absolute last place where we're going to be thinking about the change of bias. And it's still okay. It's better than, let's say, something below that. So if that's the case where we just have to come to this place, and decide that the bias has changed, then, so be it. This is where we are with our bias definition. But obviously, we want to identify some of the better characteristics that would suggest a distribution to us, and we would get out earlier. But that's the main thing. One of the main points that I'm making throughout the last 2-3 sessions about volume is that when you look at the volume signature, sometimes you are distracted by the volume itself, and you forget to look at what the price is doing. And volume does not necessarily a good representation of what the price could be doing, right? We could have an increase in the volume signature, and it could suggest different things. It could suggest an increase in the supply, or it could suggest both increase of the supply and demand at the same time. And those are two different things. That's why volumes could be so confusing. As a tool, I think visualization of volume is really bad. It confuses people just because there are two different forces in a single bar, and the volume bar is usually given some kind of bias definition just by the default. If the price goes down and closes below the previous day's close, the volume bar is going to be red. But this volume bar could contain a lot of demand, and this is where confusion comes. So therefore, we need to look at the price to define what supply and demand are doing on a specific volume bar. So in first case, the price is reversing up after making a higher low, and then it steadily starts to go up. So we are suspecting that our accumulation bias is being confirmed. In the second scenario, once we have the commitment below the low of what we thought was a potential spring, that's it. The scenario of the spring is negated, and because of the failure, we're starting to think that the bias is to the downside, and that we need to acknowledge this commitment to the downside as a sign of weakness. And that's the main difference. So even though we study the volume signatures, we study the supply signatures and the demand signatures, it's all useless if you're not using the price and what the price is doing, how the price reacts to that emergence of the supply. So this exercise is all about that. And if you're going to take something from today's session, take that. This is a very, very important concept. All right, great. All right, now let's go to the next portion of our class. We're at 4:30, so we'll definitely go to 5:30, and let's just see where we are with that. at that point. So I keep showing you guys the homework that you keep sending me. I really like so many variations that you send. So this one comes from Jose, and this is just phenomenal work. I like the table. I like all of the abbreviations here. I like all of the comparisons. All of our material is here, and then such great, forum to show the explanation for each bar, and then there is a legend here. So that's just very cool. So thank you for sending this, Jose. Another example from Doug, and this one has a little bit more elaborate description for each bar. So again, I love this a lot, and with that also comes, a more abbreviated version for each of the bars. So that's also great. A couple of questions from Doug, so let's address this right away. The volume. When evaluating volume effort, so let's make a distinction. Volume and effort are two different things. Effort is going to be looked at us as the difference between, let's say, volume